subscribe now and press the bell icon. Never miss an update.
We finished up to CTC, child tax credit. There is a age test, citizenship. The person needs to be a US citizen or staying in US and all those things. We saw all of that. And we saw what is the dependent tax credit and all. Right, there's something is refundable and something is not refundable. So can anyone tell me the difference? What kind of credit is refundable?
Yes, ma'am. Child tax credit is not refundable.
Then what is refundable?
Child and dependent care.
Additional child tax credit. Why do you guys keep forgetting? Yes, CTC is not refundable, but we have seen it many times. ACTC is what gives refund, right? And Garima, what you were saying about American Opportunity Tax Credit, most of the time it will not be refundable, but yes, there is, we went through it, that there is a clause that up to 40% of that can come up as refundable. Right, up to 40% can come up as refundable only when certain conditions are satisfied.
Okay, ma'am.
What is the other education credit that we talked about? Shweta?
Lifetime.
Lifetime learning credit.
Perfect, lifetime learning. So the any difference that you can cite out between AOTC and a lifetime?
For AOCT, we have the limit of 4 years, which is not there in lifetime credit,
Right.
and 20% of qualified expenses are allowed as credits in lifetime credit, whereas that is not the case in AOTC. That is 40% of credit is refundable in AOTC, which is not in
In
lifetime.
AOTC, it's 100% of first
Half of
2000 and
2000 qualified
40% of
expenses.
next 2000. Right.
Yes.
And that's why the maximum per AOTC is 2,500. What is the maximum as per the lifetime learning credit?
2000.
2,000. Correct. Correct. And before that, we went over the foreign tax credit and stuff, and we know this formula is important. How to calculate, because it gets reduced by this ratio of foreign taxable income divided by worldwide income. But we know that foreign tax credits can be taken forward. It can be carried forward up to 10 years and carried back 1 year. Okay, then we looked into educational credits. Perfect. Then we covered up child tax credits, dependent care. The dependent credit is reported on form 2441. So what are the conditions? Who can tell me, honey, what are the conditions to claim 2441 tax credit? Can anyone get that?
Both filer and
Person
spouse
should be in
full-time
employment.
employee.
Perfect. Yes. Yes. I
And
thought you
also,
said both of them should be working, right? Is that what you said?
Yes.
Yes.
next is taxpayer provides more than half of the cost of maintenance of a house.
Yeah, that is what the dependent will qualify for.
Yeah.
The person will qualify as a dependent. Yes. But very important, even
Must
if the
live
person gets,
with the parents for more than half of the year.
yeah, that is also okay, but provided that all the conditions to qualify that person as a dependent has been satisfied.
Important is to have the SSN number of service provider.
Yes, it is very important to have the EIN number and the details of service provider. They should have made that payment to somebody outsider. It should not be to any relative and all those things, right? We looked into all those stuff, and either both of them need to be student or working. Otherwise, it's not allowed because that doesn't serve the purpose. The credit, the maximum that you can claim is 3,000 for one person, one dependent. So 6,000 for two or more, and the credit is equal to 35% max, but it gets phased out if the AGI is increasing. Okay, so that is all okay. What we need to remember is in W-2, lot of times we will see DCB, dependent care benefits given by employer. This is very commonly seen. That say $5,000 is given by employer as dependent care benefits. That's all part of the CTC. So now that $5,000 will have a different code in W-2. So when we enter that, it all comes up as a taxable unless we go ahead and put the information in 2441 that yes, dependent care benefits were given by employer but they got used towards the dependent care expenses, then some credit will come or the deduction will come. Otherwise you will see it on line, the first line, wherever you put W2 it will say DCB 5,000 or 10,000, whatever the employer is giving. So it's very important. The moment we see DCP, that means the dependent care expenses has been given. In order to make sure that that comes up as, uh, tax free, we need to make sure we are putting in all right kind of information. Okay, so this is important because most of the clients will get affected by CTC, ACTC, and other dependents and all those things. So this is something which you will see in 90% of the returns. And that's why I was like putting in some more time towards that. Okay, so now we'll go to the next one, retirement savings contribution credit. As the name suggests, there has to be some money or some contribution that needs to go to retirement account. And if that's been done, and if other condition of meeting the income threshold have been satisfied, then person may get something which is called savers credit because they are saving for their retirement. So again, this is something good for the economic, good for the nation, good for their personal finances and all, and that's why there is an incentive which is given by IRS in terms of savers credit. Now, what all kind of retirement contribution people can put money into? 401k, Roth, simple IRAs. These are all different kind of retirement schemes. We don't need to go through in detail for that, but 403b, 501c, and any other plans which are specifically for retirement, they can qualify for the tax credits. Usually, we don't see that very often because I think the income limit has been quite low for that, and most of our clients will go above the limit. Now there are certain other conditions that the taxpayer has to be 18 or older. The person who is putting money into the retirement plan, you cannot say that okay, I'll put money on behalf of my kid and all, and I need that. That person need not be claimed as a dependent on another person's returns. We cannot put money for a dependent and try to claim the saver's credit. That person cannot be a full-time student. Now, what is considered to be a full-time student doesn't necessarily mean that for 12 months you need to go to college and then only you will be considered as a full-time student. Again, that definition may differ. So IRS is clearly saying what is meant by full-time student, that a student, if during any part of 5 calendar months, if that person was enrolled as a full-time student. Okay. But that does not include on-the-job training courses and all. We cannot say that. That is because I'm doing on-the-job some training and all. That doesn't make the person to be a full-time student. So let's look into it. The credit can go up to 50%, 20%, 10%, and all. Again, we don't need to memorize all these numbers. We need to just understand that the credit may come up. How it can go up to 50% if the AGI is really less than $41,000. As per IRS, this is low for married filing jointly, given all the cost of living expenses in US and all. So they'll fall under low income group. That's why they get the maximum credit. As the income increases, the credit may go down. So let's go over one of these examples. Varunji, can you please read?
Stephanie's husband was unemployed in 2022 and did not have any earnings. Stephanie contributed $1,000 to her IRA in 2022. After deducting her IRA contribution, Stephanie's adjusted gross income on her joint return is $38,000. Stephanie may claim a 50% credit, that is $500 for her $1,000 IRA contribution.
Right. So she is married. So we'll look into the married category. She's earned so much, and her husband is having no earning. He was unemployed, and she contributed 1,000 to her IRA. So in order to claim the credit, she definitely has to contribute something to the IRA. Sorry, not to the IRA, to any retirement plan. Otherwise, she cannot take the credit. So they are saying that she has put in $1,000. Okay, and after deducting her IRA contribution, her income becomes 38,000 because that will not be taxable. And Stephanie may claim a 50% credit. Why 50% credit? Because her AGI is less than 41,000, so she can claim 50% of the credit of the amount that she is putting into IRA. So up to $500, she can take that as a credit. That is on top of the deduction she is already getting. So her income, taxable income, is already reducing from 39 to 38. On top of that, because they are under this category, there is an extra incentive given that they'll take another $500 credit. That means their liability will get reduced by $500. This is non-refundable. It will not lead to any refunds. Only the liability will get reduced. Okay. And this AGI we have to see depending on the taxpayers adjusted. Okay, this we already talked about. The taxpayers adjusted gross income we need to see. So her AGI becomes 38,000. And I mean, anyways, even if it was 39, it was below 41. But then we need to see the AGI after she is contributing. This is credit for the elderly or disabled. Now, what is elderly? What is disabled? What condition need to be satisfied and all? Let's just go over that quickly. Elderly meaning there has to be an age of 65 and above. Okay, that is considered to be elderly for the purpose of this credit. Before the close of the tax year or retired before the close of the tax year due to a permanent disability. Even the person may be below 65, but the person may have some kind of permanent disability. Something, physical, mental disability, something must have happened and the person is not able to work. So even that is also a genuine condition that also needs to be taken into account. Not necessarily that, okay, this is the only condition. You reach 65, then only you'll get the credit. This credit is for elderly or disabled. And there are a lot of benefits given to disabled people in US. There are extra laws for them. They're like, if you're not aware, every building which is constructed, every public, not public property, I would say, every like place where public can enter, like into a shop or temples or church and all, everywhere there has to be a proper access given to people, those who are disabled. Meaning, if they're coming on wheelchair, there has to be a ramp. This is as per the law. You cannot just put the stairs there and say, okay, done. I mean, if you're disabled, get couple more people and they'll help you go there. No, there has to be a ramp somewhere on the side. There has to be an elevator where the wheelchair can get inside. Even for the buses, the bus transportation, train, everything, they have this ramp kind of thing that when the bus stops and the driver sees that there is a disabled person, he needs to get down, needs to open the ramp, make sure the wheelchair is going up and all. So there are a lot of benefits given for the disabled. That's how the law is like. And so I'm not surprised that, I mean, there is a credit for disabled as well. Again, how to calculate that and all, they are saying certain rules here. It has to be 15 times of initial base amount and all, and they're giving the base amount, which is for married filing jointly, it has to be 7,500. And for married filing separately, also there is a base amount. And the base amount has to be reduced by certain benefits that they've already received, like social security or annuity benefits, pension or disability income. There's disability benefits given by the government as well. So all those we need to reduce, and then we need to see what is the base amount coming to. We have to adjust those things. A married person filing separately can claim this credit. If most of the credit you will see, if they are going for married filing separately, they will not be able to get it. But this credit they can still get it. But a married person filing separately and who still lives with the spouse at any time during the year will not get it. They're just making it confusing, but that's what the rule is. So this is a little bit of flow chart, and it's very easy for us to understand if we go it this way. It's individual, like who is the qualified individual for the credit for elderly or disabled? Who gets qualified for this credit? So we'll start here. Was the taxpayer married? Yes, fine. Did the taxpayer live with a spouse? Yes. Is the taxpayer filing a joint return? Yes. Then fine, all these conditions need to be still satisfied. If the taxpayer living with a spouse and if the taxpayer is not filing a joint return, the taxpayer is not qualified, cannot take the credit. So again, let's start here. Was the taxpayer married? No. Fine. Is the taxpayer a US citizen or resident? The person cannot be a non-resident. Then we say no, still no. And again, there is still a possibility that they may get it. Okay, we just have to come to this. So let's go over here. Is the taxpayer US citizen? Yeah, let's say yes. And the taxpayer 65 or older. At the end of the tax year, yes, the person may take the credit. No, if the taxpayer is not 65 or older, then we have to see if there is any permanent and total disability. Temporary disability is not considered for that. There can be people, those who can be temporarily disabled. Maybe they got into accident, they have their leg or hand fractured or something, they're on the bed for a few months, but that's called temporary disability. It has to be a permanent. Yes, then did the taxpayer still reach mandatory retirement age before this year? Okay, even if the person is permanent and totally disabled, still we need to see if this year the taxpayer is reaching the age of retirement. And if we say no, then we have to see did they receive the disability benefits. If the person is receiving disability benefits from any other organization or government and all, then that person can still claim. But if the person is not receiving, then they cannot claim the credit. Okay. Again, this is the taxpayer, US citizen, resident, alien. If you're saying no, then it will come to here that the taxpayer is not qualified. Is the taxpayer retired? No, again, not qualified at all. Only if the taxpayer is living in US, even if that person is non-resident for some time, if they're there, then they may still qualify. But completely non-resident may not. Okay, so let's go over one of the examples that we have here. Karima, do you want to read this, 8.9?
Yes, ma'am. Virginia is 66 and unmarried, claims the standard deduction and has not started to receive any retirement income. In 2022, Virginia's AGI is $15,500 and her taxable income is $800. That is 15,500 minus 12,950 deduction, standard deduction, minus 1,750 additional standard deduction, creating $80, that is $800, 10% of the $800 tax liability. Virginia's remaining base amount for the elderly credit is $1K, that is 5K minus 50% of 15,500 minus 7,500, creating $150 credit, that is 15% of 1K. Virginia's $80 tax liability is less than the $150 credit, so she can only claim $80 of the credit.
Okay, so let's look over here. I think this is the confusing part. We all understand she's 66. One of the conditions she is satisfied. She's unmarried. Yeah, but we can still see, like, I mean, she'll fall into single category and all, but we'll see if what can she go for. And her income is around 15,500. Okay, her taxable income is 800, which is completely, this is a very standard calculation. Whatever that income is, you reduce it by standard deduction. There is additional standard deduction given to her because she is above 65. So that way she is getting a liability of so and so. Now let's see what is the base amount. So here this is what they have given. The credit is equal to 15% times of initial base amount, which is 5,000 for single, I would assume 7,500 for married filing jointly, and this much for married filing separately. In her case, she's single. So we'll take 5,000. So 5,000, okay, and this 5,000, this initial base amount is reduced by the following. So this is the base amount for her, in her case, because she is single. And now we need to reduce it by what? By any social security benefits, any annuity benefits she got, any disability income. Did she get anything? Are they saying no? There's no social security benefit, no pension or annuity, and nothing of that. So, what is the fourth condition? One half the excess of AGI over 7,500. The AGI is 15,500. Any AGI above 7,500. So we will see what is the difference between these two. And you take one half of that. So excess of AGI over 7,500, we are taking one half of that for 7,500. Why we are taking 7,500 here? Because that is the amount given for single. They are clearly saying 10,000 is the amount for joint or 5,000 for married filing separately. So that's why we are doing this calculation, and then we are reducing it with the base amount. In her case, it is 5,000, so it comes to $1,000 is the remaining base amount, and then we take 15%. And so the 15% of that is $150 credit. Her tax liability is $80, so she can completely get away from her tax liability, but it will not lead to any refunds. Her tax liability will go from 80 to 0 because she's having $150 credit. The credit cannot get carried forward, she'll lose rest of the money, but it becomes 0. Again, these things, don't get very hooked up on that, how to do this, and we need to remember all of that will be done by software. Okay, the base may change, the amounts, the limits may change and all, given the inflation and cost of living index and all, it may change. But what we need to remember is, are we putting the correct birth date for them or not? Because the birth date we are making a mistake there, obviously everything will fall apart. By mistake, if we put some other birth date, then we are not showing her as 66, then it's gone. So it's very important to just put clearly our own data. And if again the software, her income is very low and she is above so and so, so she may be eligible for elderly credit, but if the software is still not showing or it's not coming up, maybe there's something we are missing. So we need to go to that particular page, other credits, look for where is the elderly credit calculation happening, go to that and see why it is not giving up. Now let's look into the next one is adoption credit. Again, adoption is very, very common in US. A lot of kids who get adopted and all, it's very commonly seen. Like probably very usual to have a colleague in the office or your neighbor and all who has adopted a kid. It's not as popular in India or maybe other countries, but it's quite popular there. And so adoption credit is also available. Again, that's something which is encouraged by the government, right? The children, those who are orphans and all, it's better if they get adopted and they get good household and all. There are certain expenses which will go for the credit. Only those are expenses which are reasonable and necessary. Again, this is a very, very important word, reasonable and necessary. You will see this word everywhere, whether it's business expense or adoption expense or something else. It has to be reasonable expense. It cannot be unreasonable. It has to be a necessary. It cannot be a luxury. It has to be a necessary. Okay, and which will include like fees, court costs, attorney fees, and all. I mean, whatever is reasonable in that category. Again, attorney fees is not something we can say that only this much can be taken as a deduction. but given the data they are in that particular geographical location, whatever is a reasonable amount. And any other directly related expenses. Any other expenses, we cannot take them for adoption credit. We have seen this chapter earlier also, adoption expenses and all. Okay, any costs associated with a surrogate parenting arrangement. No, this can just blow out of the proportion. It can go through the roofs and all. Surrogate parenting is very expensive, so that is not allowed. Anything which you're doing in violation of state or federal law, people may go do certain things or bribes or kickbacks or whatever, that is obviously not allowed. Any infant care supplies, we cannot say that we have adopted a kid, we need to get all those things, medicines and clothes and all, so we need for that. Okay. And who can be adopted? An eligible child under the age of 18 years. They can go for 14, 15-year-old kid adoption as well. But the child has to be under 18 years age, or it can be any age if the child is physically or mentally, or not just child, if the person is physically or mentally incapable of self-care. Can be a 40-year-old person. If that person cannot take care of himself or herself, then somebody else can adopt that person. So credit is allowed. What is the maximum credit? Is 14,890 and all. And again, it will get phased out. Again, this is a universal rule. At what limit it gets phased out and all, they are giving it here. You don't need to memorize that. Here, the important part is the unused credit may be carried forward. So if they don't use it, that's fine. Next year they can carry it forward. And it will not be subject to AGI phase out. So the carry forward is not subject to AGI phase out. You can always carry it for the next 5 years. There are very few credits, those which get carried forward. So this is one of them. Otherwise, if you don't use it, you just lose it. Foreign tax credit definitely gets carried forward. So, okay, let's go over this example. Honey, can you read 8.10?
Yes, ma'am. A taxpayer with modified AGI of $80,000 pays $15,000 of qualified adoption expenses to adopt a 10-year-old girl. As part of taxpayer's employee benefit program, the employer reimburses the taxpayer for $5,000. This amount reduces the taxpayer's qualified adoption expenses to $10,000. Thus, the taxpayer can only claim a $10,000 credit for qualified adoption expenses.
Correct. So again, whatever they're putting here is very reasonable, very commonsensical and all. If the employer is paying for that, if the employer is reimbursing, obviously the taxpayer cannot take credit because they can just take credit for the expenses actually going out of their own pocket. Okay. What is qualified adoption expenses? We have already seen that. So, and this is the maximum credit they can get now. Yeah, if the credit is reduced if the taxpayer receives any excludable adoption assistance from an employer and all that, we need to see if there is somebody else who is helping them out, and not just the employer. There might be organizations, there might be NGOs who are encouraging this and also maybe trying to help in terms of expenses. So all that needs to be taken into account. So we'll just finish off this residential mortgage interest credit and then we'll close. Quickly, residential mortgage interest credit. This is different. Okay, we always see in Schedule A that mortgage interest can be taken as a deduction. Or if the property is put up for rent, then we can take that as a rental expense on Schedule E. Right? I hope everybody remembers that. Divyansh, do you remember? Rohit may not have done it. Where do we put mortgage interest expense as a deduction? If it's for primary residence, what schedule is used? Please tell that. Anybody from Ujjain? If the interest is paid on primary residence, how can we take benefit of that?
From primary residence, it is taken in Schedule A, line 8, and for rental, it is taken into Schedule E.
Good. Yes, very good. If it's primary residence, again, that's something, it's a activity that every government will encourage. They want their residents to go and have their own home, so they're kind of encouraging it by giving a deduction. If it's a rental property, then obviously all their direct expenses related to property are deductible, so they can derive to net income and pay taxes only on the net income that comes up. Now, here we are not talking about the mortgage interest deduction, we are talking about mortgage interest credit. Again, this is not very usual credit that you see. It's not something very popularly people talk about, but it is possible. How? If you take some mortgage, then state or local governments can also give some kind of mortgage interest or some kind of you know like some kind of incentive on that, and they may issue mortgage bonds in lieu of certain taxes exempt bonds and all. So we need to ask the taxpayer, if the taxpayer is saying that, well, I have some mortgage credit certificates which is issued by the state government and all, and when they have financed their own house, in order to encourage that, they may give some bonds. So they may say that, okay, if you're taking a mortgage of $500,000 or $100,000, we'll give you certain bonds where you can also earn interest and all. So, but that happens only when on the first purchase of principal residence, because they will not give away this money for free, right? It's just a way of encouraging. But if you are regularly buying and selling your house, that means you don't need help with the first purchase of principal residence. And okay, any of the MCC credit which is disallowed can be carried forward. Again, the carry forward thing will come automatically in your tax software. If we are putting that up and if it's been unused, there is always a carry forward, a small worksheet there or tab there. You go to that and see what is being carried forward to the following years. Let's go over this example.
Residential mortgage interest credit. David and Lyda paid $4,800 of interest in 2022 on the mortgage given upon acquiring their first home. They received a mortgage credit certificate that specifies a 20% credit rate. They are entitled to a credit of $960, that is $4,800 into 20%. The amount of mortgage interest they may use as an itemized deduction is reduced by the amount of the credit to $3,840. That is $4,800 minus $960.
Yeah, so think of it as a some kind of scheme, like like a lot of times if we go and take credit card, the bank will say that, okay, we'll give you some 5,000 rupees back or 1,000 rupees as a, I don't know, as an award, or as a something like in terms of award and all, because we are signing up for their credit, or some reduction in interest and all. So think of it that way. So that the mortgage credit certificate is given to them 20% rate. That means they can take 20% credit on the total mortgage which has been paid by the taxpayer. But obviously, if they are taking 20% credit, then they're already taking advantage of this amount. And now the mortgage interest that they may use on their Schedule A as a deduction is reduced by the amount of credit. So they cannot take, even though they paid full 4,800, but they cannot take the entire deduction. It's just meant to be fair that you cannot take deduction as well as credit on the same mortgage interest. So let's be fair there. If you're getting a credit, maybe getting a credit is much more beneficial because it is straight away reducing your liability. So take that $960 credit, but then reduce your deduction by so much that you would still be an advantage. Okay, we just need to remember, is there something called mortgage credit certificate that client has given to us or they have uploaded, we need to look through it carefully. Is there any mortgage credit certificate on the first purchase? It's only for the first purchase. Is there any interest mentioned there? What is the MCC rate and all? And then we can apply to it and see if they're getting the credit. Again, if you're going for the mortgage interest credit, automatically software knows that this is on the first purchase of the primary residence, so it should automatically go and reduce the itemized deduction amount. It should, but sometimes it doesn't do that. So we should be able to go back and check whether it's making that adjustment or not. Does anyone remember what is MTC?
Minimum tax credit.
Perfect. Yes. And when did we read about it? Divyansh, when did we read about it? What chapter were we doing?
AMT.
Perfect. AMT. AMT gives rise to MTC, right? The AMT is something alternative minimum tax. Only when the person is paying that person gets to use MTC as a credit that can be used for the future years because of the extra tax that they are paying in that current year. The AMT is coming into the picture. That means the regular tax liability is lower than AMT, and that's why the taxpayer is asked to pay more. When they are paying more, what they are essentially doing is they're collecting these minimum tax credits. Okay, all good. Then we'll close it here. Any questions?